So stay right there. Welcome back to the Keiser Report. Time now to go to New York and speak with Joshua Brown, author of this new book. Get a good look at it. Backstage Wall Street, in which Josh tells the world about all the tricks Wall Street uses to convince you to act against your own financial self-interest. Now, Josh, welcome to the Keiser Report.
Bonjour, Max.
Now, Joshua Brown, it seems like you hired Greg Smith to go out there and write that letter to the New York Times to help promote your book. Is that true?
Yes, it's very true. I owe him a basket of flowers and fruits.
All right, speaking of Greg Smith, Josh Brown, people were shocked that Goldman Sachs refers to its clients as Muppets. Despite all the wealth destruction of the past decade, the population still believes that Wall Street is there to help them make money. Of course, in your book, you explain why that's not the case. But why? What about this Greg Smith letter? Do you think it's much ado about nothing, or is it going to have legs, as they say in show business?
You know, I was actually pretty critical of his op-ed. And people are somewhat confused about what the difference is between me and him, because I've just written this kind of tell-all Wall Street book. So the major difference is that Greg is delusional. He seems to think that over the last 5 years something has changed. So I think Greg is kind of fooling himself in thinking that everything was fine for 12 years and then all of a sudden something changed. It's always been this way. If you do the research in the history of Wall Street and Main Street relationships, which is what my book covers, there's never been any difference. It just becomes more or less obvious depending on the era that we're in.
Josh, a lot of times on business cards on the retail brokerage industry, it'll say something like financial consultant. So people expect that when they they go to a financial professional that they are receiving some kind of consulting services. So in Greg Smith's letter, he exposes the fact that, in fact, the brokerage industry is a carny sideshow that's ripping you off. You make the same point in your book. What about this level of fraud as it relates to the institutional side of the business, Josh? Because when you hear about municipalities that are being sold junk, not junk bonds, but literal toxic securities from J.P. Morgan and Goldman Sachs, and these towns across America are going out of business because of the bucket shop tactics that you explore in your book. What about the systemic fraud and the fact that these systemic fraudsters are now in high positions in government? What about this, Josh?
Just because someone is a, quote, institution or a, quote, accredited investor, it doesn't necessarily mean that they're any smarter than an individual investor. And the protections of institutional investors and accredited investors, meaning wealthy people, are significantly less than they are for other people. It's assumed that, well, this guy's rich and he's a doctor or he's a lawyer or he runs a pension plan for a bank. Don't worry about him, he'll take care of himself. And of course, that's never the case. But I think the more important point here, Max, is that there are the fundamental conflict and problem on Wall Street for the average American right now is this. There are two standards of care. The first standard of care, the traditional, is what's known as a suitability standard, meaning the product that I sell to a customer as their broker or financial consultant or whatever I want to call myself does not have to be in their best interest. It simply has to be suitable given the investor's risk tolerance, goals, etc. Meaning, I can sell them something like an A-share mutual fund with a 5.75% front-end load, even though it's not a good thing if I were the client's fiduciary. From a suitability standpoint, it's a suitable investment. There was a poll in 2010. They asked affluent Americans whether or not, their stockbroker was their fiduciary, had a fiduciary obligation to them. 93% of affluent Americans said yes, in fact, he does, and they were all wrong. So there's a difference between being someone's fiduciary and just being someone's broker who's held to the lesser suitability standard. And no one knows the difference other than people in the industry. I think that's something that needs to change, and I've dedicated a lot of my time on the blogs and in the book trying to bring that out.
Well, Josh, it sounds like you're parsing words a little bit. In my case, I had a Series 7 broker's license until it expired when I left the business, but I have had that license, and in acquiring that license, the differentiation between suitability and fiduciary within the spirit of the license gives you the right to be a licensed stockbroker, there's a very similar, although technically what you're saying, differentiation, but the spirit of this is that you're not supposed to gouge your client's eyes out, rip off their head, and poop down their neck. But let me get back to this point about pension funds versus doctors. Okay, if a doctor gets involved with a Goldman Sachs broker and the Goldman Sachs broker rips his eyes out and ruins his life, that's the doctor's responsibility. But a pension fund manager is managing money for other people. It's a third-party transaction. They have no idea what's going on. And a lot of times we find out that these pension managers are in cahoots with these brokers on Wall Street, and they're ripping these people off unmercifully in a way that's through a third party. So here you have third-party institutionalized fraud. Now this is a huge problem, no?
Max, you and I really see eye to eye on that point. And I think the fact that the regulations basically state that, an institution is on their own because they're smarter, they should know better, is not really taking into account the fact that the money that the institution is managing is retail money. At the end of the day, if you're managing a pension fund, yes, you're an institution, but the people whose money is with you, that's individual investors' money. That's people that are expecting to retire. So I don't understand why there would be two different sets of protections, whether someone's accredited or institutional versus whether someone's retail. So I think you and I 100% agree there.
All right, you talk in the book about famous bucket shop D.H. Blair, which has a notoriety on Wall Street as being the inspiration almost for movies like Boiler Room, where you have these brokers who are participating in classic bucket shop scandals like pumping and dumping, etc. They, of course, went out of business, but a bucket shop like Goldman Sachs stays in business. Why is that?
I think there are some pretty big differences between the wirehouse firms and the penny stock pump and dump firms of the 90s. What I would tell you, though, is that the bucket shops are still alive and well. There are a lot fewer of them because the regulations have tightened and made it harder for them to stay in business, but they're still out there. The latest things that they're doing are private placements, private real estate investment trusts, things that are not opaque, that can't be marked to market necessarily, things where there's a lot of room to play around with the numbers and to have that asymmetric information differential. That stuff is still going on to this day, although there are less firms doing it. I think there's a difference between that kind of stuff versus what you're talking about with the Goldmans and the larger firms. I don't know that you can really say that they're the exact same thing.
All right, let me give you 5 words and tell me if it resonates with you. Net it and forget it. Ring a bell?
Yes.
All right, so here you have an over-the-counter stock where the spread between the bid and the ask is not reported as a commission. You're taking down stock on the over-the-counter desk. You're putting in $1 or $2 on a sales credit, which could be 10, 20, 25% of the equity, and you're wiping people out. Now, how is that different than when Lloyd Blankfein says, I'm making a market in derivatives. I'm both the buyer and the seller. I'm going to pack in a 10% credit to my firm, and the day one from when you start, whether you're Greece or a pension account or some retired person in a mutual fund, you're down from day one. How is that different? Why is Lloyd Blankfein not in jail?
Max, you got me on that. I haven't really looked at the way the institutional side is trading in and amongst themselves. It's not necessarily my area. I would say that, though, really, to just get back to my original point, I think when you look at the way individuals versus institutions are treated by Wall Street, there should not be two different standards of protection. On that, you and I agree. And I don't understand why we assume the guy managing funds for retirees at a bank is any smarter than the individual who's accorded extra protection from the street. I think everyone should be treated with the same standard of care, and right now it's just not the case.
All right, let me hold up the book again. Okay, the book is called Backstage Wall Street. Joshua Brown is the author. He's got a website called Reformed Broker. You can follow him at Twitter at Reformed Broker as well. And the way I would characterize this book is that it's a book of self-defense. It tells you how to defend yourself against that phone call at 6 o'clock at night from some broker who is looking to get you into the next big thing. Is that a fair characterization, Josh?
Absolutely, Max. I think you nailed it. And you're an ex-Series 7, and I'm an ex. I dropped my Series 7 as well. And I think that there's really no reason in this day and age for anyone to buy investment products from someone who's making a commission on the sale of that product. That is not financial advice. That is not a fiduciary role being carried out. All that is somebody selling you something that they know more about and that they're taking a margin in. And I think that you absolutely nail it. Nobody needs to be pitched anything over the phone, in a meeting, at a seminar. People need to defend themselves. People need to read the book and understand the difference between sellers of product versus providers of advice.
I just wanted to follow up. Our last conversation on the show, we were talking about the new hot wave of social networking sites like Groupon, and Facebook's coming down the pike, Twitter. It's a big phenomenon, and now we've had some trading action in those stocks. Groupon went public, for example. And so what are your thoughts currently on this sector? And we only have about 30 seconds, but are you still, do you have any thoughts on this sector? I mean, this is typically the sector that people are going to get phone calls about. They'll get that phone call that says, hey, Mr. Jones, you've got this social networking stock. It's hot as a pistol.
There's one thing that I think everyone should be aware of, and I'll probably write something about it. Right now, some of the bucket shop brokerage firms that still exist have figured out a way to buy shares from Twitter and Facebook employees who need liquidity. They're taking these shares, they're bundling them in these private funds with escrow accounts, they're layering fees on top of it, and these are restricted shares of stock. They're selling this to people as though they're buying pre-IPO shares in Facebook, when in reality, what they're really buying is shares of a fund that owns stock that may or may not be sold at some point. It is probably the biggest scam going on right now. People are cold calling investors with this thing. I think everyone should be on their guard. If somebody calls you up and offers pre-IPO shares of Facebook at a discount, it's a lie. They don't have them. They won't give them to you. You are about to be screwed. And I think that that's the number one thing that's going on right now with the social media companies. Do not trust anyone who's got something that's too good to be true. Facebook, Twitter, etc. is a great example.
All right, good enough. The book is called Backstage Wall Street. Joshua Brown is the author. He's the reformed broker. Thanks so much for being on the Keiser Report.
Thank you, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Joshua Brown of Backstage Wall Street. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.